Lululemon just posted a monster holiday quarter on the surface, but if you actually read the transcript, they're quietly bracing for a literal boardroom war while trying to actively starve their own customers of inventory. It is a very weird dynamic. Welcome to Earnings Unscripted. We are looking at the Q4 results for Lululemon, ticker LULU, today, March 17th, 2026. Revenue hit $3.64 billion, which is a massive 41.9% jump from last quarter, and earnings came in at $5.01 a share. So on paper, Miro, it looks like a pretty easy win.
I mean, it is a win if you only read the headline. The top line jump is nice, but it is mostly just holiday seasonality doing the heavy lifting. The operating margin did expand sequentially to 22.3%. Up from 17 in Q3. But the real story is what is happening under the hood. The structural cost of keeping that engine running is flashing yellow. North American buyers are just completely trained to wait for sales at this point.
Right. Markdowns went up 130 basis points, I think, which is kind of painful. But actually, before we get too deep into the existential threat of discounts, I should just quickly throw in our usual reminder that this is all just our personal opinion. Definitely not financial advice, so don't, trade your yoga pants based on our chat. But going back to that North American fatigue, the stock action really kind of reflects that exhaustion, doesn't it?
Yeah, totally. The tape has been a complete roller coaster. They had this really sharp rally mid-quarter, pushing up near the 225 level in late January, and then the bottom just fell out. It gave up almost all those gains heading into the print.
And then after the bell today, it basically just drifted. Like it hit a low around 154, had a tiny bounce during the call, and then just sort of faded down about 1.5% to close around 156. It feels like the market just does not know what to price in right now.
Because there are too many moving parts. You have interim co-CEOs running the ship right now. And then, this is the crazy part, management casually slips a comment into their SG&A guidance about discrete costs related to an upcoming proxy contest.
Wait, they just name-dropped a proxy contest in the forward guidance? Like, oh, by the way, we are fighting for control of the board.
Literally, yes. The CFO was outlining expenses for 2026 and just, flags a proxy fight like it is a routine utility bill. That means an activist is already at the gates. When the official CEO chair is empty and you have a corporate war looming, the market is going to hold back its capital, regardless of how well the international side is doing.
Which is a shame because China was an absolute beast this quarter. International comp sales were up 20% year over year, and mainland China was up 30%. But I love how they're trying to solve the North America problem. Did you see the bit about the tennis tournament?
Setting up the pop-up tent to outfit Francis Tiafoe at Indian Wells? Yeah.
Yeah, for their new Show Zero sweat concealing line. And the crazy part was 2/3 of the people walking into that tent were brand new to Lululemon. So there is still this massive untouched consumer base, even in saturated markets. I think they need to figure out how to get the right products to them faster, which is where the AI strategy comes in.
Exactly. And that is probably the most consequential operational shift in the whole report. They are completely overhauling their supply chain to collapse the go-to-market pipeline from 2 years down to 12 months. They are heavily using AI and automation to do it. Because if you want to stop discounting, you have to actually be reactive to trends instead of guessing what people might want 24 months from now.
Okay, yes, there is so much to unpack there, especially the activist boardroom drama and the giant tariff nightmare they're staring down for next year. All right, let's get into the details.
Let us actually start with that tariff nightmare, because when you look at the 2026 outlook, the gross margin is just taking an absolute beating. They are staring down an estimated $380 million hit next year.
Right. This is the whole repeal of the de minimis exemption. Like for years, they have been using that provision to ship e-commerce orders from Canada straight into the U.S. duty-free. And now the government is basically saying, yeah, no, time to pay up.
Exactly. It is a massive structural cost increase. Megan Frank, the CFO, was completely blunt about it. She said they anticipate a gross tariff impact of approximately $380 million. They are expecting offsets from enterprise efficiencies of around $160 million, but still.
Wait, so they take a $380 million hit, they find $160 million in corporate efficiencies. That still leaves a giant $200 million hole in the gross margin. How do they plug the rest of it?
By forcing you to pay full price. That is really their entire strategy for North America next year. They are initiating what is basically a planned supply starvation.
Wow. Okay, supply starvation. Break that down for me, because last quarter they were kind of swimming in inventory.
They were, but they cleaned it up nicely for the holidays. Inventory dropped about 15% sequentially to $1.7 billion. And going forward, well, Megan Frank specifically noted this on the call. She said throughout the year they expect to see units approximately flat to slightly down, which, she added, is, quote, part of how we are supporting driving that full price inflection, unquote.
So they are artificially capping the amount of physical clothing they produce. Like, even if they think a certain jacket might sell well, they'll hold back the units to keep it scarce.
Precisely. Because if you overproduce, you inevitably end up marking it down. And markdowns are what got them into this margin squeeze in the Americas in the first place. I mean, they took a 130 basis point hit on markdowns this quarter alone. So it's essentially retail rehab for the North American shopper. They have to retrain the consumer to stop waiting for the sale rack.
Which is incredibly hard to do once you have trained them the other way. I mean, psychologically, right? If I know those specific leggings go on sale every January, I will absolutely wait. The only way you break that habit is if I go to the website in January and my size is already gone.
And that is exactly what they want. Scarcity drives prestige and margins. And actually, they noted that the Canadian consumer has been even more sensitive to markdowns recently, which is, it is their home turf. So they actually guided Canada downward compared to the U.S.
Oh, interesting. I missed that part. So the fatigue is real across the whole continent.
Yeah, but to pull this off, to run inventory that lean without missing your top line targets, you need absolute precision on what you actually choose to manufacture. You cannot afford misses.
Right, which totally circles back to that AI supply chain overhaul we mentioned earlier, collapsing that go-to-market lead time from 2 years down to basically a year.
Yes, it is a really tight feedback loop. You use AI to shrink the design and production timeline. That lets you chase current trends rather than forecasting 2 years out, which means you can manufacture fewer units, but theoretically the exact right units, which then limits the markdowns, which finally offsets the giant tariff tax they are about to pay.
That is a terrifying amount of pressure on their operational models, though, because if the algorithm gets next winter's color palette wrong and they do not have backup inventory in the warehouses, they just completely miss the season.
True, but keeping the status quo wasn't an option. The margin bleed in the Americas specifically was just becoming structural. They had to rip the Band-Aid off somewhere.
That makes perfect sense. They need every penny of profit working for them, especially if they are going to be bleeding cash to fight an activist investor proxy contest in the background. So looking at this whole chessboard, where does this leave them heading into the next few months?
It leaves them playing a massive game of defense right out the gate. The Q1 guidance is, it is honestly a little brutal. They are forecasting net revenue around $2.4 billion, which is basically just 1 to 3% growth year over year. And that gross margin is expected to drop by 380 basis points almost immediately.
Because the tariff reality hits on day one, but all those shiny new AI supply chain efficiencies are going to take months to actually show up in the math.
Exactly. The cost is totally front-loaded. So the entire full-year outlook, which expects moderate 2 to 4% growth overall, completely hinges on that supply starvation trick working. Megan Frank literally said, quote, baked into our total revenue guidance for North America is an improvement in full-price sales. They are heavily betting the back half of the year on retraining you to pay retail.
Which is such a massive behavioral gamble. I mean, they are trying to fix a cultural problem with an operational limit. And they're doing all of this without a permanent CEO. That is the part that still kind of blows my mind. You are fighting an incoming proxy war, rewriting your entire manufacturing timeline, and actively holding the line on consumer pricing. But the captain's chair is still technically empty.
Yeah, the boardroom is going to be just as volatile as the balance sheet this year. But to give credit where it is due, they are not completely paralyzed. They are still planning to open about 40 new stores globally, mostly riding that massive momentum in China. And their payback period on those physical stores is under 12 months. That is a phenomenal return on investment.
Right. It's not a broken company at all. It feels more like a company going through a really intense operational transition.
they're learning they can't just coast on early pandemic brand vibes anymore in America.
Very true. The core machine is highly profitable. They just have to outrun their own margin bleed before the activist investor steps in and pulls the levers for them. Let's see if they name a real CEO by the time the next quarter rolls around.
Right. We'll just have to see who's actually sitting at the head of the table on the next call.
If you want these earnings unscripted to just automatically show up for you, go ahead and follow the feed. We actually build this show using AI tools, which is exactly how we can compress those giant corporate filings into a conversation so fast. We would really love to hear your ticker requests, so just shoot an email over to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks so much for hanging out with us today, and we will catch you after the next bell.
See you out there.